Financial institutions are not eliminating cryptocurrency. They are incorporating blockchain technology to modernize existing systems. This shift does not invalidate decentralized crypto, but it does change where and how it can be used. Market volatility, cyber attacks, and on-chain exploits remain well-known risks for cryptocurrency holders. But another, quieter shift is underway, one that has less to do with price action and more to do with structure. Major financial institutions and regulators are no longer standing outside blockchain technology. Instead, they are increasingly integrating into traditional finance through regulated frameworks, bank-issued stablecoins, and the tokenization of real-world assets. Rather than opposing decentralized crypto outright, these institutions are adopting select elements of blockchain to improve efficiency in payments, settlement, custody, and asset management. In doing so, they may be reshaping where institutional capital flows and which forms of crypto remain relevant inside the global financial system. Developments such as the EU's markets in crypto assets or the MiCA regulation, banked-backed stablecoins from Societe Generale and JP Morgan, and tokenized funds launched by BlackRock all point to the same direction of travel. At Numeratus, we view this not as a moral question about decentralization versus centralization, but as a structural one. Who controls the rails, who sets the standards, and which assets remain usable as the system evolves? This analysis examines the mechanisms behind these developments, the tools being deployed, and the implications for decentralized cryptocurrency ecosystems. Now let's talk about the gathering storm, or the real plan. The early narrative framed crypto as an external challenger to traditional finance. Banks were skeptical, regulators cautious, and crypto positioned as an alternative system. That framing is now outdated. Rather than resisting blockchain, financial institutions are integrating it on terms that align with existing regulatory and operational models. This integration is advancing along three primary fronts: regulation, bank-issued stablecoins, and tokenization of real-world assets. First, let's touch on regulation. The EU's MiCA framework, which entered into force in 2023, established clear rules for crypto assets, stablecoins, and service providers. Stablecoin provisions applied from June 30th, 2024, while the full framework for crypto asset service providers became mandatory by the end of 2024, with transitional arrangements extending into mid-2026. MiCA provides legal clarity, but it also imposes requirements about licensing, reserves, governance, and audits. These are more easily absorbed by large financial institutions than by decentralized or lightly capitalized crypto-native projects. Second, bank-issued stablecoins. These are digital representations of fiat currency issued by commercial banks, distinct from central bank digital currencies. They are designed to operate within regulated environments while offering faster settlement and round-the-clock availability. Third, the tokenization of real-world assets. This involves representing assets such as bonds, treasuries, equities, real estate, and commodities as digital tokens on blockchains. Institutions such as the World Economic Forum have highlighted tokenization's potential to improve efficiency and reduce operational friction, while also emphasizing the need for common standards to avoid fragmentation. Together, these developments point towards a more integrated institution-led blockchain ecosystem, one that may prioritize regulated, permissioned applications over fully decentralized ones. So what about this new financial instrument, bank-issued stablecoins? They represent one of the most immediate institutional uses of blockchain. Unlike central bank digital currencies, which are liabilities of central banks, these tokens are liabilities of commercial banks and are backed by reserves under existing regulatory frameworks. Their purpose is not ideological, but operational: faster settlement, lower counterparty risk, and improved capital efficiency. In Europe, Societe Generale's SG Force launched the EUR coin convertible in 2023, initially on Ethereum. Since then, it has expanded to additional blockchains, including Solana and the XRP ledger, operating with MiCA-compliant structures. In the US, Citigroup's Citi Token Services enables institutional clients to tokenize deposits and move them globally on a 24/7 basis. Pilot programs with multinational firms have demonstrated the use of tokenized deposits and smart contracts for trade settlement. JP Morgan's JPM coin, originally used internally, has expanded its interoperability by supporting connections to public blockchains and multi-chain networks designed for institutional use. From a Numeratus perspective, these instruments are not attempts to replace crypto-native stablecoins for retail users. Instead, they are designed to retain institutional liquidity within regulated banking systems, reducing the need for large pools of capital to exit into open, permissionless alternatives. This is the type of transition Numeratus focuses on, not whether a technology succeeds, but how it is absorbed, constrained, or redirected by existing power structures. Blockchain adoption by institutions does not eliminate decentralized crypto, but it does change the competitive landscape for liquidity, access, and relevance. Understanding these shifts requires looking beyond individual tokens and towards infrastructure, regulation, and capital flow incentives. Now let's talk about the good old Trojan horse, which is tokenization of real-world assets. Tokenization is often presented as a neutral efficiency upgrade, and in many respects, it is. By enabling fractional ownership, faster settlement, and programmable compliance, tokenized assets can reduce friction in capital markets. However, many current implementations are permissioned, requiring identity verification, compliance checks, and approved counterparties. BlackRock's USD Institutional Digital Liquidity Fund, or BIDL, launched in 2024, illustrates this model. The fund provides tokenized exposure to short-term U.S. treasuries on public blockchains while restricting access to qualified, whitelisted participants. By early 2026, the broader market for tokenized real-world assets had expanded significantly, with estimates ranging into the hundreds of billions of dollars and projections reaching into the trillions over the next decade. This growth suggests the emergence of a substantial on-chain economy, but one where participation is increasingly gated by regulatory and institutional requirements. Interoperability with fully decentralized assets may be limited, not by technical barriers, but by compliance and governance rules. Now let's talk about the squeeze, how crypto becomes marginalized. The integration of blockchain into traditional finance is unlikely to produce abrupt disruption. Instead, the effects may be incremental. On-ramps and off-ramps may increasingly favor regulated tokens. Institutional DeFi applications may accept only permissioned assets as collateral. Surveillance and reporting requirements may become standard with these ecosystems. Decentralized cryptocurrencies remain viable for peer-to-peer use and self-custody. However, their role in mainstream financial activity could diminish if institutional capital concentrates in regulated tokenized environments. In this context, worthless does not necessarily mean zero. It can mean reduced utility within the dominant economic system. Now let's talk about the last bastion, the uncontrollable alternative. Despite these shifts, decentralized cryptocurrencies retain properties that institution-led systems cannot replicate. Bitcoin, in particular, has no issuer, no centralized governance, and no permissioning authority. Its censorship, resistance, fixed supply, and global accessibility remain distinct. As regulated blockchain systems expand, these attributes may matter less for institutions, but more for individuals and entities seeking independence from centralized control. From a structural standpoint, decentralized crypto becomes less about integration and more about optionality, an asset outside the dominant system rather than inside of it. Financial institutions are not eliminating cryptocurrency. They are incorporating blockchain technology to modernize existing systems, potentially redirecting capital towards regulated, permission environments. This shift does not invalidate decentralized crypto, but it does change where and how it can be used. At Numeratus, we focus on understanding these transitions early, examining incentives, infrastructure, and power dynamics rather than narratives alone. If you want to engage with this level of analysis and better understand how structural changes in finance affect asset relevance, liquidity, and risk, you can explore the Numeratus community and client work at numeratus.us. Because in evolving systems, awareness is not optional. It's all about positioning.